The Federal Reserve made a big decision this week. They decided to keep interest rates the same. This is the third time in a row they've done this. The president was not happy. He took to Twitter to voice his displeasure, calling the Fed chair, Jerome Powell, a fool. The president wants lower interest rates. He thinks it will help the economy grow faster. But the Fed is worried about inflation. They don't want prices to rise too quickly. It's a tough, balancing act. The president has been very vocal about his desire for lower interest rates. He's been hammering this point since he took office. He believes that lower rates will boost the economy. He points to the stock market as evidence. He argues that lower rates make it cheaper for businesses to borrow money. This, he claims, leads to more investment and more jobs. However, critics argue that the president's focus on the stock market is misplaced. They say it doesn't reflect the experience of ordinary Americans. They also point out that the economy is already doing well. Pushing rates too low could lead to inflation. This would hurt everyone, especially those on fixed incomes. Fed Chair Jerome Powell is sticking to his guns. He's made it clear that the Fed will not be bullied by political pressure. He insists that the Fed's decisions will be based on data, not tweets. In his statement following the rate decision, Powell emphasized the uncertainty surrounding the economy. He specifically cited the ongoing trade war and its impact on business confidence. Powell stressed the importance of a data-dependent approach. This means the Fed will be closely watching economic indicators like inflation, employment, and GDP growth. They will adjust interest rates accordingly, but only when the data justifies it. This cautious approach reflects the Fed's commitment to its dual mandate of maintaining price stability and maximizing employment. Bill Adams, an economist at Kamea Bank, offered his perspective on the Fed's decision. He pointed to the conflicting economic data that the Fed is grappling with. On one hand, backward-looking indicators like GDP growth and unemployment look pretty good. The economy is growing and jobs are being created. But on the other hand, forward-looking indicators like consumer confidence and business investment are painting a less rosy picture. Adams believes that this divergence in the data is largely due to uncertainty surrounding the trade war. Businesses are hesitant to invest and hire when they don't know what tariffs will be in place in the coming months. Consumers are also holding back on spending, worried about the impact of tariffs on prices. Section 5. The Tariff Tussle, a cloud over the economic horizon. The trade war is the elephant in the room. It's the biggest source of uncertainty in the global economy right now. The United States has imposed tariffs on billions of dollars worth of goods from China. China has retaliated with tariffs of its own. This tit-for-tat has businesses on edge. The tariffs are already starting to bite. American consumers are paying more for everything from washing machines to soybeans. American businesses are facing higher costs for imported components and materials. And the uncertainty is causing businesses to delay investment and hiring decisions. This is weighing on economic growth. It's one of the main reasons why the Fed is hesitant to raise interest rates. Section 6. The Fed's Policy Toolkit, a balancing act. The Fed has a number of tools at its disposal to influence the economy. The most well-known is its ability to set interest rates, but it can also buy or sell government bonds to inject or withdraw money from the economy. This is known as quantitative easing, and it can use its bully pulpit to try to influence expectations about the future path of the economy. Right now, the Fed is in a holding pattern. It's waiting to see how the trade war plays out and what impact it has on the economy. It's reluctant to cut interest rates further because it's worried about inflation, and it's reluctant to raise rates because it's worried about derailing the economic recovery. It's a delicate balancing act. Section 7. The Dual Mandate. Dilemma, a delicate equilibrium. The Fed's job is to keep the economy on an even keel. It has two main goals: to keep inflation under control and to promote full employment. These goals are often in tension with each other. For example, when the economy is growing quickly, inflation can start to pick up. The Fed may need to raise interest rates to cool things down, but raising rates can also slow economic growth and lead to job losses. This is the dilemma the Fed faces right now. It needs to balance the risks of inflation against the risks of a slowdown. It's a tough call, and there's no easy answer. The Fed's decision will have a major impact on the economy. But it's also important to remember that the Fed doesn't operate in a vacuum. Its decisions are influenced by a wide range of factors, including fiscal policy, global economic conditions, and even the president's tweets. Section 8. Conclusion. An uncertain future. The Fed's decision to hold interest rates steady reflects the current economic uncertainty. The trade war is a major wildcard. It's difficult to predict how it will play out and what the ultimate impact will be on the global economy. The Fed is in a wait-and-see mode. It will continue to monitor the data and adjust policy as needed. Buckle up, folks. It's going to be a bumpy ride.